Chapter 2, the title is The Financial Plan. For most people, however, financial stability does not happen by accident or through good fortune. It requires careful planning and effort. In this chapter, you will study the steps to making a personal financial plan, which can serve as a basis for financial success in your life. Our learning objectives are to describe the purpose of the financial plan and identify the key components of a financial plan. Here are some of the key terms that we will be taking a look at. Some of them you may be familiar with and some not. So hopefully by the end of the chapter you're familiar with all of them. What is a financial plan? A personal financial plan involves specifying financial goals, including spending, financing, and investing plans needed to reach those goals. This is a roadmap to stability, freedom, and flexibility. It's a roadmap to achieve the future you want for yourself and for your loved ones. A good financial plan is like a builder's blueprints. It spells out every aspect of how to accumulate and grow wealth and provide for emergencies. It helps ensure that you move forward in life. You make steady progress towards your financial goals. A solid financial plan addresses 7 key components. Each of these areas is a crucial piece to your personal financial plan, and each component requires that you make a set of personal decisions. When you're finished, you'll have a comprehensive roadmap to help you achieve your dreams. You will now spend some time understanding each area. Later, you'll have a chance to apply what you've learned when you create your own personal financial plan. A good financial plan includes these 7 components: budget and taxes, and we'll go through each one of these individually. Manage liquidity and ready access to cash, financing large purchases, managing your risks, and again, it just depends what comfort level you are with your risks, investing your money, planning for retirement and the transfer of your wealth, communicating, and record keeping. Here's a picture of each one. You'll notice that the topics are in reverse order. Each section builds on the previous one. The previous one has to be strong enough to support the next one. Again, a checkpoint. What is the purpose of financial plan? It's like a blueprint to a builder. It addresses every aspect of your financial life, and it helps you accumulate wealth and plan for emergencies. The components to your financial plan. The first step in building a financial plan is understanding the different parts of it. We will explore the 7 components I went through and how they can help you achieve your financial security. Today we're going to work with component 1, and this one takes the longest period of time because that is the foundation for all the rest. So it has to be strong before we move on. Component 1 is a plan for your budgeting and taxing. Budgeting does not have to be restrictive. It helps you plan for the things that you want. Budgeting. It is the process of forecasting future expenses and income. In other words, it involves asking how much you plan to spend next week or next month and what is the expected source of that money. How are you going to get that money and what are you going to spend it on? The purpose of a budget is to plan your spending and saving given your income level so you can meet your needs and wants. Again, it helps you plan your spending and saving so you can meet your goals. Creating a budget involves several steps. You have to determine your net worth, establish your income, identify your expenses, and consider the impact of taxes. So again, we are going to work with component 1, a plan for your budgeting taxes, and we're going to go through several steps along the way. Step number 1 of your component 1. Okay, the first step is to determine where you are financially. Do you have money in the bank? Do you owe people money? Do you have a job? What are your expenses? Knowing the answers to these questions will help you determine your current financial position. This will help you recognize how far you are from your goals and help you set your budget priorities. So you'll take a look at those questions. Determining your net worth. The formula for determining your net worth is net worth equals assets minus liabilities. And again, your net worth is where you are financially. Increasing your net worth is the point of your financial plan. Assets. Let's review that. We covered that a little bit last chapter, but assets are anything we own. Okay, it has some value, anything we own. Cash would be an asset along with cars and boats and anything else that you own. It might be your cell phone, and you can come up with things that you own. It might be your television set. Maybe you have a TV set. Maybe you have other things that are valuable, jewelry. Okay. The second one is liabilities. What we owe or our debt. Do we owe our friends money? Do we owe our parents money? Maybe they help you buy a car and you pay them back. Okay? What we owe, what our debts are. Okay? Your parents may have other liabilities such as paying off a house, paying off a car, paying off different loans that they have. Maybe they owe a business some money because they bought something on account. Maybe they have credit cards that they owe. Our net worth then in turn is assets minus liability. Equity means ownership. So our equity would also be like our net worth. For example, we have assets. Maybe a car is worth $5,000. A liability would be that we owe $2,000 on the car. Maybe we don't own the whole car. So our net worth would be our car value, the amount we owe. Okay, so our net worth here would be our assets, which is $5,000, minus our liability, the amount we owe on the car, whether we owe it to the bank or to our parents, it would be that. Oops, sorry about that. So our equity or our net worth would be $3,000. $5,000 minus $2,000 is $3,000. Okay, let's go to math problem number 1. You have $200 in your checking account. You own a phone worth $150 and a computer worth $500. You owe your friend $100 and your mom $50. You also have a credit card bill of $120. So we're going to take this whole situation and figure out what the assets, liability, and net worth are. Okay, so let's go first of all with our assets, things that we own. We own $200 in cash. We also own a phone worth $150. We also own a computer worth $500. Okay, those are the things that we own that have value, so therefore they're assets. Okay, the total of all our assets is $850. Next, we're going to go on to our liabilities, things that we owe, people we owe money to, or businesses that we owe money to. So if we take a look at it, we owe $100 to a friend. We owe $50 to your mom. And you also have a credit card bill of $120. You owe that money to the credit card company. You add that all up and you get $270 worth of liabilities. Okay, so now we know what we own and what we owe. Next, we're going to figure out what our net worth is. Okay, so we're going to take our assets of $850. We're going to take our liabilities of $270 and we'll subtract that because assets minus liabilities is our net worth. And so our net worth would be $580. And that is the solution of our problem. So we have an equity or a net worth of $580. Going on and including step 1 of component 1, determining our net worth. As you save money, you will accumulate more assets. including cash. You will also have the chance to reduce your liabilities. If you pay them off, you'll reduce your liabilities. Both of these will lead to increasing your net worth. So in other words, you can increase your net worth by increasing your assets or decreasing your liabilities. So your net worth or your equity will go up. Let's just take a look at this diagram here. It's a car. You own some of it, you owe the bank some of it. Okay, and you can see your assets here is your car worth. The car is worth $5,000. Okay, because you own $3,000 of it and you owe $2,000. So the total value is $5,000. The amount owed on the car is $2,000. You owe the bank $2,000. So your net worth would be $5,000 minus $2,000 is $3,000. A question, what color will the car be when it's paid off? It means that you would own the whole thing, so therefore it would be blue. How much will the net worth be at the time that it's all paid off, assuming the car is still worth $5,000? The net worth would be $5,000. Keeping in mind things like cars and boats and motorcycles and all that depreciate in value. So it's by the time you get it paid off, it's probably not really going to be worth $5,000 anymore. And we'll cover depreciation a little bit later on. Okay, that was determining your net worth. Step 2 of this first component, remember we're in component 1 of 7. Step 2 is establishing your income. Your income is the money coming in through wages earned, allowances, or other sources. A key factor, again, in shaping a budget is understanding your income. Having an income is a major means by which a person saves money, builds wealth, acquires assets, and fulfills their needs and wants. If you don't have income coming in, it's going to be a tough life for you. A person's income often depends on decisions made about education and career choices. In general, remember, more education or specialized training translates into more income. Think about the people you know. Who makes a good income? What jobs do they have? You will probably list several professions, some of which required a college degree, such as a medical professional and teachers. Other professionals, such as electricians, mechanics, and plumbers, receive very specialized training. In most cases, you'll find out that the higher income comes from higher level of education and or training. Let's take a look at math problem number 2. Jamal makes $9 an hour and works about 15 hours a week. He also gets $25 per week allowance. What is his total annual income? Okay, we're taking a look at, so his solution, his job, he has 9 hours times 15 hours a week, so he's going to make $135 per week at his job. $135 per week times 52 weeks per year, he is going to make $7,020. He also gets an allowance. Lucky guy. He gets $25 per week times 52 weeks per year, and so he's going to get $1,300 per year in allowance. His total annual income, therefore, would be the $7,020 he gets from his job, plus his $1,300 he gets from his allowance, and so he'd be making $8,320 per year. So again, that's just one way of figuring out what your annual income is. So that was step 2 of planning for your budget and taxes. Okay, step 3 then of this same component, a plan for your budget and taxing, is identifying your expenses. We've identified our income, now we have to take a look at our expenses. Expenses are the money you spend on something, and that's pretty broad here. When creating a budget, estimate how much money you have going out every month. What do you spend your money on? Typical expenses include clothing and entertainment. You may also have some related expenses. What else? Think about it. What else? What are other things that you spend your money on? It may be a car payment, maybe a phone bill, maybe gas for your vehicle. Your parents also have different expenses. Can you think of some expenses that your parents have? Okay. They may have a house payment, a car payment. They may have credit card bills. They may owe businesses money because they bought on credit. Okay, so there's lots of different expenses out there. They also have the heating bill, the utility bill so that you have water. They have food bills. Okay, so again, expenses are different according to your age. Here's an example, and this is a pretty old table, but I couldn't find one any more current, but it kind of summarizes 7 different age groups and what you spend your money on. If you look at you guys, you are under the age of 25, so you can take a look. Probably the biggest chunk, not for you, but for college students, would be your housing. Okay, and you can see the other chunk here, that's pretty big here. The purple is food, and the dark green is transportation. And then you have the others like personal items and stuff like that that you may spend your money on. Your consumption patterns will change over time and are highly dependent on your stage of life. So if you look at like your parents' age, pretty close to that, you can tell pretty much what they are spending their money on. And you can see the different types of expenses: food, housing, clothing, transportation, healthcare, entertainment, pension and Social Security, which would be your retirement, and other things. You need an accurate estimate of your expenses to determine how much you can save. Remember, savings for the future requires sacrifice spending today. So if you spend $20 on a new shirt today, that means you cannot save that $20. Step 4 of our first component is considering the impact of taxes. Income taxes is the money owed to the government on earned income. Income taxes may also impact your budget. The more money you make, the higher share of your income you will pay in income taxes. Include tax planning in your financial plan as your income level increases. So again, as your income increases, as you start your career, you will begin to include tax planning as your financial plan. Okay, so I'm going to flip back to an earlier slide that we had just to summarize here. And we're going to take a look, just as a little review here. What we did today was we looked at component 1, a plan for your budgeting and taxes. Okay, under this component, we looked at the steps: determining your net worth, establishing your income, figuring out what your income is, identifying your expenses, and considering the impact of taxes.